Adjusting journal entries is the fourth step in the accounting cycle and occurs at the end of each accounting period after the trial balance is prepared. They are simply entries that are made in the general journal, which looks like this, in order to record revenues that have been earned but not recorded, and expenses that have been incurred but not recorded. In other words, it is similar to the accrual accounting, however the revenues and expenses are being recorded to keep the journal up to date. An important tip to remember when attacking adjusting journal entries is that cash is never involved within any of these entries. Cash will only ever occur before the end of the period or after the ending period. This is evident in this diagram, where you can see cash is never present in the adjusting entry. There are two different scenarios that can occur when recording revenues and expenses. This diagram is a brief explanation of each scenario. However, I will go into greater detail on the meaning of each. Deferred revenue is where cash is received before the revenue is earned. For example, airline companies receive payment before you fly. This is seen by a debit of cash as cash is increasing, and a credit of liability as the company has not provided the service. If you then look at the adjusting side, you can see the debit of the liability and a credit of revenue as the service has been provided. This is often called the general rule. Accrued revenue is where the service is provided and cash is received after. For example, when you visit the doctors, you pay after the service has been provided. This is evident in the adjusting entry where receivables are debited as they are increasing because payment has not been received, and revenue is credited as the service has been provided. At the end of the period, cash will be debited and receivables credited as the service has been paid for. Deferred expenses is where cash is paid before the expense is incurred. For example, a business may pay for 3 months' worth of rent in advance before even using the rented space. This is evident in the diagram where prepaid assets are debited as they are increasing, or in the case of the rent, the company is paid for the use of 3 months, and cash is credited as it is decreasing due to them paying for the rent. For the adjusting side, expenses are debited as they are increasing. In other words, the company may have used 1 month's worth of rent, therefore they have incurred the expense, hence it will increase, and prepaid assets will be credited as the company has used up some of this asset. Accrued expenses is where the expense is incurred and payment is made after. For example, businesses pay their employees after their employees have provided labour. This is seen in the adjusting entry where expenses are debited as the employees have performed labour and payable is credited as the company owes its employees for this work. The entry after the end of the period shows the payable being debited as the company has paid their employees' salaries, thus cash will be credited as it is decreasing.